Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Happy Halloween. So the Federal Reserve made their decision about interest rates this week. They cut the Fed funds rate by another 0.25% or 25 basis points. I think that was widely expected by everybody, including the market, so there were no surprises there. I think in the announcement, what was interesting was that they're going to stop quantitative tightening next month. And that is certainly going to be more impactful to markets than the Fed funds rate. Remember, the Fed funds rate is the rate that banks can charge each other overnight for loans. So it's the shortest of short loans. It's why cutting that Fed funds rate has not moved the long end of the yield curve. So long dated bonds rates really haven't budged because ultimately those rates are set by the market and the Fed really can't control those rates. But where they can have some control is with this quantitative easing or tightening. And they've been quantitative tightening, meaning that they've been restrictive with the money supply, and they're getting rid of quantitative tightening, so the money supply is going to grow again, which is certainly not good for inflation, right? If you have more dollars out there in the system, that's certainly going to be inflationary. And so what the Fed has said without saying it is, we do not care about inflation. We care about asset prices and the labor market. Because inflation is 50% higher than where they say they want it to be. And if they're even going to stop their quantitative tightening, that's going to also be inflationary. And so the Fed is admitting without outwardly admitting it that they do not care about inflation, or they don't care about inflation where it is at 3%. They don't really care about getting it back to 2%. And so the good news is that anybody that owns assets like houses and stocks, it's certainly good for asset prices, and it will be good for the wealth effect. Meaning as those things continue to rise in value, everybody feels richer and spends more money, but also that is inflationary. So it's quite interesting. The Fed is in certainly a difficult position. It's not a job that I would want, but they're clear that they don't care about inflation where it is. And so for a lot of Americans, that's quite painful. That could have some implications, certainly politically. I guess we'll wait to see how that plays out. But the Fed continues to try to make monetary policy easier, which is interesting considering that we have most assets at all-time highs. And Josh can talk a little bit more about asset allocation and earnings.
We're in the week of earnings season that matters the most, simply because all of the big tech heavyweights reported this week. Remember, earnings season started off with a bang with all the big banks reporting. Deal making and IPOs are back, which has been a fee bonanza for money center banks. But this week we got big tech earnings. All of the big tech companies are basically eating the entire economy. By any measure, earnings have been awesome, both relative to expectation and on an absolute basis. Interestingly, Facebook was a good point this week in that these big tech stocks, relative to the expectation at least, can sell off dramatically and shed hundreds of billions in market cap just by missing expectations very marginally. Of course, a lot of money is being reinvested in capital expenditure. Also, interestingly, you're seeing a lot of layoffs in corporate America. It's very clear that the technological revolution as it relates to artificial intelligence means that big business can do more with less. Certainly, all of those remote workers out there may be alarmed with respect to the future job prospects out there because corporate America definitely is showing the ability to cull large levels of employment. Profit margins are really at all-time highs, but the big takeaway is that earnings season has been absolutely stellar, and massive amounts of money to the tunes of hundreds of billions of dollars are going to be invested in capital expenditure. You're now seeing that sort of play out, and other companies that are related to AI are starting to outperform. Caterpillar this week being a case in point, so it hasn't fully sort of digested through the rest of the market, but small caps and international have been very stellar performers as of late, and we think that that's going to continue. And as it relates to our own asset allocation, diversification has really paid off in 2025, but big tech has continued to be a stellar performer as well. So really everything's doing well, which has been a huge positive for clients.
But remember, markets are quite expensive on any measure that you look at them. So while we're not calling for 2008 again, we are thinking that we need some steam valve release a little bit, where we're going to potentially get a correction. It doesn't mean you should do anything binary with your money, but I just think that we want to remind people that markets don't go straight up forever, and that a correction is probably needed and would be healthy for markets. So, of course, we don't know when that's going to happen, and we're not going to do anything about it, but I would just sort of get mentally prepared at some point for a correction, because we certainly need one. All right, as always, if you have questions about your situation or your account, give us a call at the office, 800-743-0988, or you can email either one of us, Josh or Tyler, at northwestquadrantwealth.com. Everybody have a happy and safe Halloween. We'll see you back here in a couple weeks.